So companies put out these quarterly reports and they're filled with lingo and jargon and all kinds of answers, but not very many descriptions as to what they all mean. GAAP, non-GAAP, where does the FSD deferred revenue show up? We'll demystify that. I'm Brian. Welcome to My Tesla Weekend. So we're joined today by Matt Smith, Managing Partner at Good Soil Investment Management. Matt, thank you for taking the time today to talk with us.
Thanks, Brian. Happy to be here. I do think it's a mystifying topic that a lot of people don't have a lot of insight on, so happy to shed some light where I can.
Yeah, and tell us real quick, what are your credentials? What's your background? How do you know this stuff?
I'm a nerd. That's why I know this stuff. No, my background, so I have degrees in finance. I got an MBA as well, but really the way where I kind of learned the majority of this is in my professional career. So I started off in finance doing financial valuation. And a lot of the work that I was doing there, you kind of need to know accounting journal entries and that sort of thing. And then from there, I went into investment banking. And that's when I really kind of got, the importance of accounting really ground into me. So one of the things that I was tasked with doing when I was in investment banking was make like a projection of a company's financials, so their income statement, a balance sheet, and statement of cash flows, such that they would all tie together, and you could make adjustments on like a top line revenue growth line assumption, and it would all flow through to the statement of cash flows and to the balance sheet, and the balance sheet would balance without you cheating and just saying, okay, equity equals the difference between assets and liabilities. So I spent a lot of time going through a lot of kind of tedious work, getting to know how different accounting journal entries would be made, and then how those impact the various financial statements. So it's I've spent way too much time thinking about it, I guess, is the short answer of why I'm qualified to answer these questions.
And an even shorter answer is what you did is exactly the questions that we have.
Yeah. I mean, most people don't need to know this much detail, and that's it was a necessity for my job, and it's just been kind of a hobby ever since. So I've kind of kept up with it.
So let's start with the big ones. What is included in GAAP versus non-GAAP?
Sure. So GAAP, for those who maybe are not familiar, stands for Generally Accepted Accounting Principles. And so that's the kind of the rules of the road where there's a governing body that basically says how things need to be accounted for. Companies have a little bit of leeway, but for the most part, they need to fall within generally accepted accounting principles, and their auditors make sure that the financial statements that they post adhere to those principles. But that said, generally accepted accounting principles, or GAAP, as most people know it, are not necessarily the most beneficial way to present things for investors or for stakeholders. So companies will typically have like a non-GAAP earnings per share is the most common way to look at things, but non-GAAP financials that they present in addition to the GAAP. So this, in Tesla's case, the biggest difference between the two is that the stock-based compensation expense, so think of like the stock awards to Elon, but also employees have these stock awards that are granted to them. Those are non-cash expenses, and so there's a rationale to kind of exclude those. And we can get into that in a little bit more detail because there's more reason to exclude them other than the fact that it's a non-cash expense. But generally speaking, you would just add back that stock-based compensation for Tesla to Tesla's GAAP earnings per share to get to the non-GAAP earnings per share. But the other companies will have different reasons to back out various things, and they do a reconciliation where they kind of make that walk.
Okay, so a lot of things are included in debt that people might not traditionally think of. So if Tesla wanted to reduce their debt to zero, how close could they practically get without fundamentally altering their business entirely?
Yeah, I mean, they could probably do that today if they really wanted to.
Right.
I mean, there may be some kind of prepayment covenants that could preclude them from doing that. Sure. But most importantly, they'd want to keep a healthy cash balance. But this is something where, like, I think most people don't realize how debt light the Tesla really is. So Most companies will have something close to like a 50-50 capital structure. And what that means is if your market cap like Tesla's is, let's say, $1 trillion, most companies would have like $500 billion of debt, and then I guess technically that's not quite right. I have to walk that back a little bit. If your enterprise value is $1 trillion, then you'd have like a $500 million market cap and roughly $500 million of debt. So if you look at Ford and GM, they actually have a little bit more debt than their market cap in most cases. Tesla's got like $1 trillion market cap, and they only have, I believe it's about $8 billion of debt that they have. So it's a really small amount of debt, and their cash balance is actually about $18 billion as of the end of Q4 21. So if they wanted to, they could basically pay $8 billion, wipe off that debt, and still have $10 billion in cash. And that wouldn't really fundamentally alter their business, other than the fact that it's really helpful to have a cushion of cash, because there's this concept called working capital. And so if you think of Tesla's business model, where they're spending a lot in the first 2 months in particular of each quarter, because they're paying suppliers, they're paying employees to make the cars, they're buying steel, and then they're selling the cars in a very heavy way towards in the third month of each quarter. So they're getting a lot of cash out the door the first 2 months, and they're getting cash back in the door in the third month of each quarter. So we don't have detail on exactly how deep that cash balance dips in the middle of a quarter, but I'm sure Zach Kirkhorn kind of wants to keep that cash balance at a comfortable enough level, which is why they haven't reduced the debt to zero, say, right now.
But wouldn't they, with $1.5 million reservations on the Cybertruck, isn't that $150 million in debt right there?
Sure, but it's also, it's not debt technically. So the accounting entry for that would be you get cash in the door, so you're debiting cash to increase that balance, but then you have a liability on the other side of the books. It's a customer deposit. So technically, yeah, they can use that cash to fund things within their business if they need to, but I think want of cash is not necessarily the reason that Tesla hasn't eliminated their debt to zero. I mean, they don't really need to, but I think you can see it in their financials each quarter. They kind of chip away at it, and I would imagine before too long it probably will be completely or very nearly eliminated.
Well, and even companies like Walmart have tremendous amounts of debt.
Yeah, well, and there's a reason to. In fact, there's a great guy. He's called the Dean of Valuation, Asmath Damodaran, and apologies if I'm botching his name. But he was giving Tesla all sorts of crap a couple of years ago because they were issuing so much debt. But from a financial theory, debt has a lower cost of capital than equity. So if you're a Tesla shareholder, there's this concept of I forget exactly what it's called, but like basically the most optimal capital structure. So if you have things that you need to finance, or even if like you just wanted to pay shareholders like a big fat dividend, like a one-time dividend, if the company's balance sheet can stand up to it, then it makes sense to add on a little bit of debt at a 4% interest rate or something like that, and use that to either increase your dividends to shareholders or to basically fund your investments, your CapEx plans. So that's a very kind of normal finance theory thing. Most companies do that. I think Tesla's maybe a little bit gun shy because, well, first of all, their credit rating is still not quite investment grade, which is laughable. But also, they've kind of come under fire recently, and their stock price is pretty volatile. So I don't think it's in their plans necessarily to introduce a dividend anytime soon. So the timing just may not be right for them to kind of go and issue a lot of debt to increase their cash balance or pay a dividend or fund OPEX or CapEx, because they can already do all that with their cash flows from operations. Like, they're already free cash flow positive. But I think maybe if you fast forward 10 years, something down the road where they're a little bit more mature, it wouldn't surprise me to see them issue some debt at a very attractive cost of debt, and kind of use that to what that does is that increases, that juices the returns for your equity shareholders. So
sure. Do you have any theories why the debt has not been upgraded yet?
Because those agencies are dinosaurs. I mean, it's so ridiculous. Like, it should not have taken this long. And I think I forget the exact upgrade that I think it was Moody's that did the last upgrade maybe a month or two ago, and it was like one notch below investment grade, I believe.
Right.
It just makes zero sense to me. I mean, if you look at their balance sheet is pristine with the fact that they already have, like we were saying, more cash than debt. Like, like not many companies have that. Like that should be a very strong sign that things are going well. But then on top of that, their cash flows. So like that's like a static view. And that static view says, okay, they're in a really healthy position from their balance sheet. But then if you look at like their track record of cash flow generation, which is kind of an indication of how risky is your business. Like, are you burning a lot of cash each quarter, or is your business subject to giant swings in like commodity prices, for example? And if that's the case, then like that's a reason that maybe even if your balance sheet looks good, that maybe you wouldn't get an upgrade. So I think they've probably been hesitant to do that. I mean, this goes back to the Model 3 ramp, and really even way back before then, where like Tesla didn't have a viable business model for the longest time. They were not cash flow positive, so they've turned that corner back in 2019, really. But I think the ratings agencies are still saying, well, maybe EVs aren't the future, or maybe like this 3-year track record of like amazing cash flow generation and profitability is just a blip, or you're scaling too fast. So I think it just points to kind of like an inherently conservative point of view that these agencies have. So it's a matter of time, but to me it is evidence of their irrelevance.
So, where do things like the construction cost of the new factories show up on the balance sheet?
Yeah, so it'll be a decrease in cash. That's kind of how it's funded. Or like in Shanghai, you saw there was some local debt that was issued. So maybe taking a real quick step back for a second, there's this like you got to think of the balance sheet as it has to balance. So your assets have to equal your liabilities plus your equity. So that's what you always, if you're thinking of accounting, that's probably the most important rule. Your assets have to equal your liabilities plus your equity. When let's just say Tesla spent $1 billion and wanted to invest that in a factory, your cash balance would decrease by $1 billion. But then another asset, it would either be called construction work in process or property, plant, and equipment. Your property, plant, and equipment balance would increase by $1 billion, and then your accounting equation is unchanged because you've got a decrease in assets of $1 billion, and your assets also increased, but it's just a different classification.
Okay. So on the deliveries, one of the line items is sales subject to lease accounting. What does that mean?
Mm-hmm. Yeah, so most customers, pay cash or cash plus the cash that a bank provides.
Right.
If you're taking out a loan, but there's a small, I think it's around 7 or 8% of customers will actually have a lease, and so the accounting for like vehicle leases is different because Tesla can't just say, all right, we sold this vehicle and they like recognize the full amount of the sale up front, because the customer only pays say $500 a month or whatever the number is. So what the accounting rules say you need to do is you record essentially like an asset and a liability. So the asset is the fact that Tesla still owns the car. So if you think of they spend $50,000 or $40,000 to manufacture the car, that takes their cash balance down. But then they get to put the car on their balance sheet again, or they put the car on their balance sheet since it's their car. It's not the customer's car. So you get that asset, which is a little bit different. Then each month, as the customer makes their payment, the liability goes down, but they're also decreasing the asset value a little bit to account for the depreciation. So there is this operating lease liability that Tesla has on the balance sheet, and that's basically saying, okay, we own this car, however, we also owe this customer 4 years worth of being able to use this vehicle. So that amount kind of gets whittled down as each. So if you think of like a let's say the fair value of the car is $50,000, but the total value of the lease over the 4-year period is only $40,000, something like that. So it'll that $40,000 liability that Tesla has will get whittled away every quarter. Revenue will be recognized, which flows through to the shareholders' equity part of the equation. But essentially, that liability will whittle down, and then at the end of the day, Tesla's going to be left with only the asset of the residual value of the car. Now, this is actually really interesting. If you don't mind a little tangent here, I think it's actually a pretty big deal that not many people are thinking about. So Tesla did.
I'm guessing this is a
Go ahead.
question I have later, but
Okay.
please, it's about getting the cars back for nothing.
Well, not exactly for nothing, but yeah, but for more than
Please share.
share. Okay, so in that example, the car had a $50,000 value on Tesla's balance sheet, but a $40,000 liability that was whittled away over 4 years, and so then Tesla's left with, at the end of that lease, a book value on the car of $10,000. Now, this is kind of an example number. It's not the right number.
Sure.
Essentially, when they entered into that lease, they had to make an estimate of what would be the residual value of that car. And so 4 years ago, the used car market was not nearly as strong as it is today. And especially like the used car market for Teslas, like we've all seen how red hot that is. Like there are some used vehicles that are going for more than the sticker price of new vehicles. So Tesla owns all these original Model 3s from 4 years ago that are just coming off lease, like right now, basically. I mean, the first ones are going to be in Q2 technically, but then they're on the books for what I would say is very likely a highly discounted value relative to current market value. So they're going to get all these vehicles coming back that they can go and sell. Maybe they sell them for $40,000 or something like that.
Right.
And then they've got them on their books for $10,000 in my example. Maybe they actually had them on their books for $20,000 of residual value.
Sure.
But they're getting, $20,000 to $30,000 per vehicle. I mean, let me just do some quick math on that. Let's say it's $20,000, and I believe there were roughly 20,000 vehicles in that first batch that were leased. I could be wrong, but assuming that. So you got 20,000 times 20,000. That's $400 million of margin that like nobody's thinking about.
And it's going to continue indefinitely. Well, for at least a year.
More than that, it will actually grow over time because if you think of their delivery ramp, 4 years ago, and I used $20,000 or 20,000 vehicles as an estimate of how many vehicles were in that initial lease. I think maybe that's too high, but
I think it is. I think it's more like 5,000 to 7,000.
I think you're right. Yeah, I think you're right.
But still, that's 100 million, 120 million, 40 million a quarter in money for just taking the car back and giving it to Carvana or someone else who can just move it.
Or just putting it on their own website. Like if you look at their own website, they've got such a dearth of used vehicles for available for sale. I'm sure they've got no shortage of customers who would love to buy one. But yeah, so as their production ramp, you think of their deliveries are increasing, 50% plus every year. So maybe it was 7,000, in that Q2 of 2019, and then maybe it's basically just increasing 50% per annum thereafter. So it's going to increase pretty drastically over time, and that's on top of their services margin is pretty strong as well because they get every time they sell a car, typically somebody will turn in a car too. We don't have to get into that, but yeah, I think it's a potentially very large catalyst that will make the profitability numbers really kind of scream. Because think like $20,000 is probably more than the margin they're getting on their sales the first time around, right? Like, it's ridiculous.
Right. Yeah. So other than bank accounts and Bitcoin, is there anything that counts as a cash equivalent?
So first, Bitcoin does not count as a cash equivalent. It's on their balance sheet under the assets as a digital asset, I believe it's called. Digital assets. So they've got about it was like $1.5 billion at first, but they took some impairment on that. So it's maybe 1.3 or so billion right now on Bitcoin. But was it marketable security or cash equivalents? They have about $150 million, somewhere in that neighborhood of basically just money market funds. And the reason for that is just like, hey, rather than sit in the bank and lose money to inflation, you don't need the full 18 billion that you have to
Right.
manage the ups and down waves of the working capital drawdowns. So why not earn, even if it's only 0.005%, at least that's something on
Right.
$150 million.
It's something.
Yeah. So it's highly liquid. It has to be highly liquid. That's kind of the key to be a marketable security.
Okay.
Or a cash equivalent. So it's not risky.
What counts as operating expenses, and what counts against it?
So operating expenses is maybe it's best to think of it as like one overall bucket of expenses. So the two biggest bucket of expenses, that there's a couple others, but there's what's kind of called cost of goods sold, and that's like all the steel that goes into the car, the factory workers, the depreciation of the plant, that sort of thing. But then there's the other bucket of expenses is kind of think of it as like the head office folks. So you've got like all your accounting, you've got your research and development team. You've got that R&D is one of the big expenses that falls under there. You're selling general and administrative. So a lot of companies would have like marketing expenses that fall under there. Obviously, that's not the case for Tesla. But one of the bigger buckets that does fall under operating expenses right now is the stock-based compensation. We're through that with, or through the vast majority of that with Elon's CEO compensation plan. But there still is stock-based compensation for all the other employees as well that kind of flows through there right now. So I kind of tend to think of it as like the white-collar employees plus all the stuff that you need at your corporate headquarters to operate a business.
So rent?
Yep, rent.
Utilities?
Utilities, yep. I'm probably
Maintenance
not utilities.
On properties?
What's that?
Maintenance on properties?
Probably, yeah. I mean, that could depend. Like if you're maintaining a machine, say on your like manufacturing plant, that probably would make its way into PP&E, and so it would be depreciation expense that would hit your cost of goods sold. But if you are like you need to repave your headquarters parking lot in Austin or something like that, then yeah, sure, like that's probably an expense that rolls through there. Like lawn service or something like that. Sure, that'll flow through operating expenses.
Okay.
I mean,
all the stock stuff is in OpEx.
Yep. All the stock-based compensation. Yep.
And revenue from premium connectivity, performance boost. Where do those go?
So that actually goes into automotive sales.
Okay.
So it's
the service line.
No, it's in the automotive sales line.
Oh wow.
Yeah.
Okay.
It's maybe a little bit confusing, but those are actually related to the car itself. So they do give a breakout in the like in the 10K, and so premium connectivity. Let me find the actual language here.
So if I sold one car that quarter and made zero profit, and then somebody who already owned a car paid $2,000 for performance boost, it would appear as though I made $2,000 in sales.
Yeah.
Okay.
Well, 2,000 in gross margin. So because if you sold profit. One car, yeah.
Right. Where does the offshore revenue and taxes show up?
So that gets consolidated in all the other lines. So you sell cars in Germany, you sell cars in China. They all kind of go into that automotive sales.
In the same.
Yep.
Okay.
So they need to, if they're denominated in yuan or in euros, they have to make a conversion to that back to dollars. So there's that to take into account. But they don't have separate financials for the geographies that they're selling into. Taxes, those do get accounted for in the bottom line. So there's earnings before tax, and then there's a provision for income taxes. It's labeled there. So that is essentially a blended rate because they're paying income taxes. I'm not sure if the company itself was subject to income taxes in California. I think it was not, but I could be wrong on that. Certainly property taxes they were, but there's income taxes. The federal income tax is kind of the big one. So there's U.S. federal income tax, which is offset by their historical net operating losses. That's something we could dive into if you wanted to. But and then there's tax rates on their operations in China and Europe and elsewhere. And so that blended rate that they have, it's close to 15%. It fluctuates a little bit, but it's been between like 10 and 20% typically historically is kind of a blended rate of all the different jurisdictions which have income tax.
You would be surprised how high the tax rate is on businesses in Shanghai. It's quite
you
high.
Cut out for a second there. You said in Shanghai?
Oh, in Shanghai, the tax rate is massive. It is, to me, a lot higher than I expected. The deal to get the land was something like they have to pay $100 million in taxes over 10 years, something like that.
So that may not show up in income taxes then, because there is a difference. So there's some jurisdictions will tax you based on how much profit you have generated from your local entity.
Right, but this is more like a
I believe it's property taxes,
B&O tax kind of thing. Oh,
yeah,
yeah.
So
great.
That sort of tax is likely to show up either in cost of goods sold or in operating expenses. Because it's kind of just like a flat line. It's not dependent on how profitable you are, how many vehicles you sold necessarily. So that's it's definitely important to keep track of it, but it does show up there in a separate line.
Gotcha. So what is the difference between diluted and non-diluted GAAP and non-GAAP? Diluted.
Sure. Yeah. So it's a very important distinction. So the company has something like 900, just shy of 1 billion shares outstanding right now of common stock. And so that's, if you own some shares, I own some shares, Elon owns some shares, you total all those up, and that's, just under a billion shares. However, there's also like stock-based compensation or the CEO Performance Award. And that's essentially gives Elon and certain employees the option to buy Tesla stock at a current price, at a set strike price in the future. So the fact that they're giving that option away, and there's also other items like there's some historic warrants. It's a very small amount right now, but there were some warrants and the convertible debt that the company issued a number of years ago. That all of those different financial instruments are highly likely, given Tesla's stock price right now, to be converted into common shares at some point in the future.
Sure.
And so this is where if you're looking at non-GAAP earnings per share, for example. So in non-GAAP, we essentially added back the stock-based compensation expense, right? So all the stuff that is non-cash, that is like Elon's stock awards and everything else, we're adding that back.
Right.
However, if we're going to do it the right way, we should take into account the fact that that stock award, that non-cash expense that we're backing out, it does have it's highly likely to result in dilution to our current ownership as shareholders. So
so it's something that's not real today, but we should absolutely be aware of as investors.
Yeah, well, and I just
because it might as well be real.
It might as well, like unless Tesla stock falls 90% or something like that.
Sure.
That's the only situation where the majority of these warrants and stock-based compensation awards and the CEO plan and the convertible debt,
bonds.
Those are all so far in the money past their strike prices that you might as well just think of you might as well just think that they've already been exercised and just use the fully diluted amount.
Sure.
So when you do that, you're more like 1.1 billion shares outstanding.
Sure.
And so as I'm analyzing the company, that's the number that I use. I just use the fully diluted amount, and I think that's the right way to look at it.
Sure. And so the dilutive convertible debt would be those bonds that that almost surely will. So you remember in 2018-ish, there was a lot of concern about debts coming due, that if the stock price isn't high enough, we want some money.
Oh yeah. Yep.
And those, I'm going to say split adjusted, those had to be $50 a share probably.
Yeah, I think I read somewhere recently, I don't know if this is current or I didn't check the math, but something like those convertible bondholders made up something like an 8x return, which for debt is like crazy, right? Like
sure,
but
anything
yeah,
over,
like,
yeah.
Tesla
Anything
did
over
that back then.
15% is pretty good.
Like 15% is junk bond territory, right? Where there's like a decent chance you're not going to get paid back, right? It's like 15% is good for an equity return. So it's for these bondholders to do that was just they made a killing on it. But you got to think back then when Tesla issued these, cash flow
it was risky,
was very tight. There was a somewhat real bankruptcy risk. And
sure.
They were in a much different spot than they are now. So,
sure.
Good for those bondholders to get paid. And I think it was a good thing for Tesla too, because they saved on some interest expense, so it made their financials look a little bit better. It made their cash flow look a little bit more positive, which was a good thing.
And they absolutely needed that cash.
They did, yeah. So they got Tesla got the benefit then, and they're paying for it now just with a slight amount of dilution, which
sure.
Yeah,
an amount that
reasonable.
we all agreed to as shareholders.
Yeah, absolutely.
Yeah. So I don't remember the most recent number. It's something like 50 to 60% of the FSD revenue is counted. Where does that other half? Where does that other half reside on the balance sheet?
The half of it is recognized. I think a little bit more than half of it by my estimates right now, but not much. And then the other, it actually shows up as a liability. So going back to our accounting, it's not debt. Okay. It's called deferred revenue.
Okay.
So deferred revenue, which if you're not an accountant or someone who's familiar with accounting, you think deferred revenue, like that doesn't sound like a liability, right? But in order to get your balance sheet to balance, you were paid the cash. So let's say $10,000 came in the door from somebody buying FSD.
Right.
You can recognize 50% of that as revenue. So that goes over here onto your equity side of the equation. But then you need to balance your assets equals liabilities plus equity. So there's a liability created it's called deferred revenue. So roughly $5,000 will go there as well. And you can think of it as a liability from Tesla's perspective because they still are on the hook to deliver that functionality to that customer.
Right.
And so they can't book the full amount until they deliver that functionality.
No.
Yeah.
Yeah. And it's people are, I don't know if you've heard this, but people are quite eager to get that finished product.
I've heard, yeah. I got the beta like 6 months ago or something like that, but I was incredibly impatient leading up to then, and like I'm still like, when's the V11 coming? And it's people are eager. There's no doubt about it.
So today's big news: rumor of a split. Are there any downsides to a split?
No. So I was, taught in my kind of traditional financial background that stock splits don't matter, right? Because, like, let's just using simple math, and let's assume it's a 5-for-1 split. Tesla's got a market cap of $1 trillion. There's 1 billion shares outstanding right now, so that's $1,000 per share, kind of using simple numbers.
Right.
Instead, if there's a 5-for-1 split, then each share will be worth $200, but there'll be 5 billion shares outstanding.
Right.
So,
but there's no downside.
There's
no reason not to do it, right?
No, I mean the only downside I've heard is that like the Dow Jones index, industrial average, for example, uses a stock price weighted ranking rather than a market cap weighting. So, like if you think of the S&P 500, for example, they weight the allocations based on the market cap of all the companies, which makes sense.
Right.
The Dow Jones, which is a much less relevant index, I would argue. But it weights them based on price. So the only downside I can imagine is
it loves Berkshire Hathaway.
Well, Berkshire Hathaway's not in there. I don't think. I haven't looked at the index lately, but like, you can imagine if Berkshire Hathaway at what are they, 400,000 a share right now.
Right.
If they were added, like that, they would just be the Dow Jones.
It'd be the most irrelevant index.
It already kind of is. So, I mean, it's just a very like backward-looking index, I think. So, that could be a downside potentially if you think that like Tesla being included in the Dow Jones would be a catalyst for the stock. Then, okay, maybe you want them to have a higher weighting, so maybe you wouldn't do that. But I think that is more than offset by the fact that having a stock price that's closer to like $50 or $100 makes it much more attainable for your average retail shareholder than where it is right now at like 1,100.
Sure.
It's just not people generally don't like to own half of a share of something or like 0.2
Right.
shares of something. I think maybe younger generations that are using Robinhood or something like that, or maybe a little bit more used to looking at it that way. But I think the majority of retail investors like to own like 100 shares of something, and you can feel really good about owning 100 shares of something. It's psychological.
Well, and a lot of self-directed retirement funds do not have fractional shares.
Yeah, that's true.
So
Some brokerages won't allow it too. So
Yep.
yeah, if you've got $500 and you want to invest your $500 every month and buy a Tesla, like you can't right now, unless you're gonna save it up for 2 months and then buy one share and then save it up for 2 months and buy another. And so yeah,
I have a very small position that I bought that has done okay, and I was thinking about selling it to get some Tesla, but it would get me like 2.5 shares, and I'm like, a little frustrating. I won't ask you to speak in absolutes, but probabilities on this one. So we've got things like the lease accounting, the cars coming off lease that are going to be insanely profitable. We've got things like Tesla buying for growth during a time when everyone else was slashing orders. The question is, what are the odds that Elon's a time traveler?
I mean, he's looking pretty smart in retrospect. I mean, it's like if you think of the things that he's made mistakes on, it's like almost like they are like just basic mistakes enough to to like make us think that he is human, right? It's like none of his mistakes have been fatal or even that bad. Mostly just either like I think of like the his comments on like that Thai cave diver and got into a little Tesla.
That was pretty dumb.
Pretty dumb. Didn't really have any real impacts though. Like it doesn't change anything about Tesla. Like years down the road. Yeah. So I don't know. I think he's just an insanely smart person who also happens to be insanely driven, and he's not satisfied. Like I think if I were in his shoes, I would have quit long ago and just been like, all right, I'm gonna,
I'd have quit with the PayPal money.
Angel investor. So yeah, exactly. Well, like everybody would, right? Like who's gonna say, like I made this crazy fortune, more than I ever thought I'd make in my life, and let's just gamble it all on like two of the most unlikely companies. Right. So I don't know. He should not exist. He should not be, like what he's done should not be possible at all. Right. I don't know how else to say it.
So I guess I'll put you down for 20% chance.
20% chance. Yeah, that sounds good.
Okay. Yeah. So I assume you're not going to GigaFest in Texas?
No, yeah, I would love to. I just had a baby almost 4 weeks ago, so if that had not been the case, then I would absolutely be there. A lot of folks I want to meet, but I'm hopeful I can get to the shareholder event later this year when they do the shareholder meeting, either in June or later in the fall if it's delayed again. But we'll see. So speaking of your most recent, your 6th child, I have 4 myself. Welcome to Team Elon Says Repopulate the Earth. We're working on it. Yeah. We're going to fight population collapse. How do you feel about what he's saying about people not having enough kids? Yeah, it's. I think he's thinking of it from like a very big picture point of view, which is kind of how he thinks of things. I think he's right that there's been probably a couple different factors that are kind of playing into this. One is people are just getting married later. They kind of enjoying the single life longer, and that has a natural consequence that you've got fewer like of your fertile years left when that's even going to be a possibility. So that's certainly playing into it. And like, hey, having kids is a ton of work. Like, You've got four.
It is.
Like it costs you time. It costs you your freedom. It costs you money to have kids. It
costs you headspace. Yeah.
Headspace. Yeah, it's exhausting. Like I hardly slept the last 3 weeks.
Right.
So like, there's a kind of a natural pushback that people say, I'd rather not do that. So at first I understand it, but I think people don't realize what they're missing. And Elon's concerns of population collapse, I mean, that's not, I'm not having kids to fight population collapse necessarily, but you can kind of imagine, let's say there's this dystopian view of the world in 60 years. Well, I'm sure going to be glad that I'm going to have kids who are productive at that point that can take care of me as like society's falling apart, right? So there's a little bit of a natural insurance if you're kind of inclined to go down that path. So I don't know. I haven't spent as much time kind of thinking of population collapse as a serious issue. I tend to be shorter term in nature in my thinking than Elon is. I think almost everybody is. But it's a real issue, and I think some of the climate concerns around like birth rates is doing us a tremendous disservice in my mind.
Sure, and from what I understand, it's not a shortage of resource at this point that would affect the maximum reasonable population. It's a misallocation of resource. It's a lack of infrastructure. It's a lack of sustainability. And those are all things that can be addressed. And yes, in every developed country, the birth rate is negative. We are below replacement.
Yep.
Would you like to take a quick second before we go to tell us about good soil investment management?
Well, I would. I want to hear your estimate on Q1 first, though. I was kind of curious. We glossed over where you think we're going to be for Q1.
I haven't finished. Finished.
Okay.
Yeah, I'm sorry. I will tweet it at you because I do release it in advance.
I don't get any preview.
Yeah, I've got to adjust for the last-minute closure in Shanghai.
Yeah, which it seems like that's, I don't know, maybe probably less than 10,000 vehicles, I would think, but it's
and they'll be made up next quarter because the parts coming in from out of the area, which tend to be the bottleneck, are not subject to shutdowns.
Yeah. I'm curious. I'm very excited to see this report when it comes out, probably on Saturday morning. But yeah, so Good Soil Investment Management, it's a hedge fund that was started by Emmett Peppers. I joined shortly after he started it. And it's essentially, we're kind of a high risk, high reward hedge fund. We're highly concentrated. Tesla's our number one name. We use a lot of options and kind of derivatives to amplify returns. So, our view is kind of that we're in this period of like incredibly rapid technological development where the stock returns over the next 10 years are probably, at least for the winners in this space, are going to be drastically higher than like historical averages. So my view is it's not a good time to be kind of like diversified across 100 names. So we have highly concentrated, it's highly risky fund. We're currently open only to high net worth individuals. Need to have a net worth over $5 million. Yeah, so $500,000 is our minimum investment. You need to have because we're so risky, we don't want our investors to put in more than 10% of their net worth into the fund because, we could be wrong and we don't want you to lose your whole life savings overnight just because we were wrong on a thesis. So
sure.
That's kind of what we're doing on the investment side, but then on the kind of social side, Emmett has, when he founded this, he was really concerned about kind of the rising tide of socialism and kind of attacks against capitalism. And so he wanted to kind of go right at the heart of capitalism. Like, people think of hedge funds as incredibly risky or incredibly greedy. Most like hedge funds that are successful out there, the managers will like buy a yacht or like a $40 million house on Fifth Avenue or condo on Fifth Avenue, something like that. And instead of kind of just like keeping outrageous returns and getting those fees to keep for himself, Emmett said, let's set an example where we're going to give 50% of our fees after expenses are paid. We're going to give those to charity. So we have charitable giving as kind of a core aspect of what we're doing. So that's a kind of what we're doing. We really hope that if we're successful, we can be successful in generating really outstanding returns for our investors, but also that we can kind of be helping to be an example for other capitalist organizations out there. That if you've been very fortunate, you've been kind of blessed by capitalism, that you would do your part to kind of lift up those who have been less fortunate in society. Because I think income disparity and kind of attacks against the rich are natural when there is such a huge disconnect. So I think it's incumbent on those who've been given much to kind of do your part to lift up others as well. So that's a bit about us.
Okay. So on Twitter, I certainly can't pronounce it. How would you pronounce your Twitter name?
So it's I started this years ago.
I'll put it on the screen.
Sort of
I'll put it on the screen.
Yeah, it's like I've heard it pronounced like Matt Chasm Matt. I don't know, but yeah, just
if you put it in the notes, I went Matt Chasm Mamat. But whatever, either way, it's on the screen.
It's on the screen. You can follow me. You can look us up at Good Soil Invest, I think is the Twitter handle, or look up Emmett at Emmett Peppers.
And I really want to thank you for giving me so much of your time. I did not expect it to run this long, but your questions were just that good.
I didn't even realize it's been almost an hour. So, thanks for having me on, Brian. It was a great conversation, and I'm prone to rambling too, so I'm sure that's part of the issue.
All right. Well, thank you so much.
Thanks.